Hi, folks. Adam Taggart, co-founder of Peak Prosperity, back here for another week of our weekly market updates that we record with the lead partners from New Harbor Financial, the financial advisory firm endorsed by peakprosperity.com. This week, we've got a special guest joining us. We've got Wolf Richter, the proprietor of wolfstreet.com, and we've asked Wolf to join us, take a break from his very busy schedule, because Wolf is one of the best experts and analysts that we know of who follows the Federal Reserve, its policies and its purchasing programs. And why that's so important is because if you've been watching our previous videos that we've been recording over the past several weeks, it's becoming increasingly clear that the only thing that you can really explain with any believability is driving the price action in today's markets is central reserve liquidity. And Wolf has been following that very closely. He is essentially going to help us determine whether or not prospects look good or maybe look a little more risky than folks realize for the markets continue to be propped up by the central banks going forward from here. So first off, Wolf, I want to thank you very much for joining us. Thanks for taking the time.
Thanks for having me.
You're welcome, and we'll try to keep this quick. We know that you've got a lot of writing to get back to. And Mike, you're joining us this week from New Harbor. I know that John is on a trip. Thanks again for making the time.
Hi, Adam. Good to see you.
Good to see you too. All right, folks. So very quickly, just want to go through little bit of context, and then I'm going to hand the football to Wolf and let him run with it. So the market experienced its most violent 30% correction in history. That was followed by the most violent 30% plus recovery in history. And as we've been covering for the past number of weeks here on the program, if you look at the fundamentals, if you look at the technical analysis, there really is nothing that justifies where prices are today. They are so divorced from the underlying fundamentals. And I think an excellent example of that is this chart, which shows the difference between the price of the NASDAQ and the 12-month forward-looking earnings for the companies that make up that index. The NASDAQ, folks, hit an all-time high today, higher than where it was back at the heights back in February. So record high for the NASDAQ, and yet the expected earnings for the index have dropped by around 40% due to the economic destruction that's followed the coronavirus here. Massive, massive disconnect. Very quickly, I also just want to put up the Buffett indicator. We looked at this a few weeks back. We are still near record highs for this. And this chart basically, folks, is a measurement used by Warren Buffett famously for determining whether the market is overvalued or undervalued. And you can see here it's at the most overvalued it's ever been in history. The only other time it's been this high was right before the dot-com crash. But looking at this chart, it is using, the chart basically uses stock prices over GDP. And the GDP that it's using in this chart right here is Q1 GDP. We're about to go into Q2. We'll shift over there in July. Well, right now, if we look at Q2 GDP at the Fed's GDP Now page, it's projected to be down in Q2 by 53.8%, right? So being cut more than in half. So obviously that shows the extent of the economic destruction that's going on in the economy. But to the Buffett indicator, it is going to send that indicator soaring. Smaller denominator, higher overall number. So in terms of being overvalued, the market will be overvalued by that very famous indicator by the most in history by a long shot. Of course, all this stands in stark contrast to the economy continuing to shed jobs. We just got the latest numbers today. Almost 2 million people, 1.8 filed for initial jobless claims. That brings the 10-week total to over 43 million people who have lost their jobs. On top of that, we have the rioting that's going across the nation right now. Just saw a stat that 30,000 National Guard members were called out in over 29 states to address the looting and rioting and protesting. So, basically we've got a market where, we're still shedding millions of jobs. GDP has dropped by over half. The country is literally being torn apart and is burning. And yet the stock market continues to hit new highs, as we saw today in the case of the NASDAQ. Huge disconnect. And of course, there's a lot of people that tell us, guys, you can throw your technical and fundamental analysis out the window. All that matters is liquidity, and that's why I'm going to hand the microphone over to Wolf now. Wolf has been watching very closely the Fed's actions, its announced programs, and how much money is actually making into the market in any given week. The question I have for you, Wolf, is for those that are saying, don't fight the Fed. If the Fed's pushing money in, the train's going to keep running and I'm going to throw my money into the market and ride this gravy train. Is that going to be as safe a bet going forward as it's been in the past couple of months?
So let me flip this around. The question I always get asked is whether I'm ready to short this market, because when you look at it, as you explained, Adam, this is a prime short scenario. But now we have the Fed behind all this, and so fundamentals don't matter. And my answer is always, and the reason I asked whether I want to short this market is because I went public with my short in late December, which I covered in early March, and that worked out well. And so now I'm like, the recipient for these questions, whether or not to short this market. And my answer is no way. As long as the Fed throws in money at this market, I am not shorting it. Now, that's not saying I'm bullish on this market, because we have an economy that's the worst economy I have ever seen. I mean, years, and I've seen some bad economies, but this goes way beyond the imagination. Corporate earnings are terrible. Those companies that are even going to have earnings that aren't going to collapse, and there's a lot of them that are in that process. So if they can't get funding from the Fed, a lot of them are going down. So this is not an economy that I'm going to be bullish on the stock market on, but I'm also not going to short it. So how safe of a bet is this? I think I sort of drew a circle around that. It is not a safe bet to be bullish on this market at this point. I think it is a very risky bet, and for a number of reasons, and one of which is the Fed is curtailing the amount of liquidity it throws at this market, and it is shifting it around. And there's already a number of voices being heard that this money printing has created an enormous amount of wealth disparity, and the people that really need it the most haven't gotten any of it. And now the top 10%, the people that own stocks and bonds in large numbers, they have really, they've made out like bandits. So the Fed is under some pressure now to not take this overboard. And I don't know that the Fed will hear on this ear, but we'll see. But at this point, the Fed has reduced its purchases of assets to right now to 68 billion a week. And it's been in that range. It's been in that 60 to 100 billion range for the last 3 or 4 weeks. And that is down from over 500 billion in the initial weeks of this process. And so we're talking about 1/10, a little bit over 1/10 of its asset purchases. So it really front-loaded this process, and now it's cutting back. It has essentially eliminated the program for mortgage-backed securities. It's still buying some, but they're essentially flat. It has cut way back on its purchases of treasury securities. It has the central bank liquidity swaps that it engaged in with other central banks, where it sends them freshly printed dollars, and they send the Fed freshly printed currency of their own making. Those have been stable. So, and the Bank of Japan has half of those. So that's mainly a thing that the Fed did with Japan, and the other half is spread over a number of central banks, including the ECB and the Bank of England and a bunch of smaller central banks. And the repo situation has calmed down. So the Fed's offering $500 billion overnight repos every day, and there are hardly any takers. So the repos have dropped in half. The outstanding repo balances have dropped in half over the last 6 weeks or so. So the game right now is somewhat in treasury securities, and it is in that long alphabet soup of bailout programs that the Fed is putting together. And there's another new item that came online today, and they're growing, but they're not growing very fast either. So there was an initial burst of $100 billion right up front of these alphabet soup bailout programs, and then they're sort of stayed stable for 6-8 weeks, and now there's some new programs coming on, and so it's rising, but by Fed standards, it's not rising very much. So the biggest thing that's rising in this alphabet soup is the PPP loans. So where the Fed takes off these payroll protection program loans that the banks did with small companies, the Fed takes them off the bank's balance sheet. And this doesn't hand any money to small businesses. It just takes those loans off the bank's balance sheet. That includes Wells Fargo, which is bumping into its asset ceiling and couldn't really play this game anymore because it couldn't add any loans to its balance sheet. It's under pressure due to the violations it has found to have engaged in. And so the Fed has said it can't grow anymore as regulator. That was happened a couple of years ago. So now the Wells Fargo cannot grow, and in order to participate in the PPP loans, it has to get rid of those loans. And so the Fed came up with this idea that the majority of those loans that the Fed is buying are probably from Wells Fargo. And so that's about where we are. The Fed is shifting over now, is buying some municipal bonds. It has bought a fairly small amount of corporate bonds and bond exchange traded funds, but these are small numbers by Fed standards. So we're looking at $60 billion a year. Now, this is still a lot of money. 60 billion a week. Now, this is still a lot of money to add in liquidity, and it's just basic money printing, and it amounts to about 250 billion a month. During the QE bailout programs back in 2012, 2013, when we had a QE infinity, the Fed was printing about 75 billion a month. So now we're doing about 65 billion a week. So this is still a lot of liquidity. And if this continues, if this continues, the markets will, I don't see that they will sell off. I mean, they should sell off, but I don't see that that's what's going to happen. Now, some of this money is going into the economy via the federal government. So the federal government is funding the stimulus checks and the
CARES Act, those type of things.
Yeah, stuff, and so there's a lot of money going out. The Fed has purchased treasury securities that the federal government has issued, and this money gets funneled into consumption essentially. So this creates consumption rather than asset price inflation. So this part, and I don't know how large that part is, but it is part of it. The other part goes into assets and promotes asset price inflation. And that's what we're looking at here. We're not looking at anything else but asset price inflation. And so how safe is this? Right now the Fed has been stable at around 60, 70 billion a week in printing money. I somehow get the feeling that it will back off of that further because there's more and more people that are important to the Fed, not me, but the people who are important to the Fed that are starting to voice some form of mild-mannered, veiled criticism of the continuance of this policy because it creates a huge amount of wealth disparity. To create this kind of situation where asset holders, and that's what we're talking about, bondholders, stockholders, anybody that holds a large amount of assets is completely made whole and has no risk while the country burns and while the economy is in the worst possible shape we could imagine. There is something wrong with this. There's something revolting about this. And there's criticism being put on the Fed now for this. Now, mild-mannered, people are not screaming at it. So I think there is continued, I have continued suspicions that the Fed will back off further from this QE, and at some point may actually step back to where it's essentially flat, where it will shift, where it will support municipal governments, and will cut back on some other things so that the net effect will be essentially zero growth. I suspect that this will come to this because if if it blows a bond market bubble and a stock market bubble that is much greater than what we're seeing now, there's going to be a revolution in this country. You just can't do this forever. We already have a lot of very, very angry and frustrated people for all kinds of reasons. And so I don't think it's a safe bet to think that this will go on forever. I think it's a trading opportunity, possibly. I'm definitely not shorting this market until the Fed stops doing this. And it may be that the Fed will add, say, 20 or 30 billion a week, and that's the magic amount that goes into consumption rather than asset prices, and then nothing is left to go into asset prices, and then the market will lose the support. So, I think at this point, and I went long earlier in mid-March, and I got rid of that, and of course, too early, but it is not a safe bet here. I don't think the stock market has ever been as fragile as it is now.
Yeah.
I just can't describe it as a safe bet.
Okay. Well, let me recap a little bit here. One, to make sure I'm understanding, but also as we talked about before we started filming, we don't have the absolute best connection here, and so I'm not sure. If in case everybody couldn't hear everything you were saying, I want to make sure we capture the highlights here. So first off, you were saying that the Fed has dramatically reduced the amount of liquidity it's pushing out into the system during this rescue program, meaning it was doing sort of 500 billion a week early on, and now we're down at more sort of the 65 billion a week level. So it's been cut by roughly 90%. But you're saying still be careful about that, because 65 billion a week is still an awful lot of money, especially if you compare it to the previous QE programs. And so you are saying you'd be real cautious about shorting a market that still has that much liquidity being forced into it. I'm really glad that you touched on the inequity part of what's going on, because that's something that Mike and John, who's his partner, and I have covered a lot in the past weeks here. And it does seem that the Fed is really getting pushed tighter and tighter into a corner here, where the market has become more and more dependent upon the liquidity that's going in there to support these crazy, stupid valuations. And so it's very fearful that if it stops the rescue efforts or putting liquidity in, that prices are going to collapse. Yet at the same time, the very liquidity it's forcing into the market is exacerbating the already pretty horrible wealth gap that we had in this country, which I think in large part was created by Fed policy leading up to 2020 over the past couple of decades. But their problem is the more in which they force that divide wider, the more likely that we are going to see revolutions and protests and things that will, come back to bite the Fed, even worse in the long run, right? Where you get to a point of rebellion and revolution, if you take it to the extreme. Did I do a good job of kind of summarizing what you had said there?
Yeah, I think you nailed it.
I'm just repeating your brilliance here. All right. And we did spend a fair amount of time last week talking about some of the challenges of shorting this market. I think you've added a really important dimension to that, which is exactly what the flows are right now that are still in play. And while I think anybody who's been skeptical of the extent of this market recovery, has been asking that question: Jesus, at what point in time do I position myself for a correction? And of course, I think the reality is nobody knows, and it could happen at any time. But I think, what I'm taking from you is, while the magnitude is still at the level it's at, it's a big risk you're taking if you fight the Fed at this point with still 65 billion going in. And let's put it this way: if you are going to go short at this time, I'm taking from what you would say is I would do it with money that I was comfortable losing. Right? I wouldn't be doing it with the majority of my portfolio. I see you smiling. So is that more or less an agreement?
I'm not comfortable losing any money.
Which is why you're not short right now.
That's right. Yeah.
All right. Well, look, Wolf, we've taken a ton of your time. I really appreciate, because I know how busy you are. And I know that we just released a much longer video with you in discussion on similar topics with Chris for earlier this week on peakprosperity.com. So folks, if you'd like more Wolf Richter, go to peakprosperity.com. You'll see a great conversation that he and Chris posted a few days back. But Wolf, thanks so much. And we will keep tabs with you. And if it ever gets to a point where you feel like the liquidity has gotten down to a point where, you no longer think that it is the key support that it currently is for the market, please let us know. We'd love to use you as one of our signals.
Okay, all righty. Thanks.
Take care, Wolf. Thanks so much.
Bye-bye.
All right, Mike, thanks for hanging in there. I know that one of the benefits of our jobs is being able to participate with big brains with guys like Wolf and Charles Hugh Smith and John Rubino and Mike Shedlock and the usual cast of characters that we bring into the mix here at Peak Prosperity. But this is the first time I think you've met Wolf, correct?
First time I met him face to face. He's been at the Sebastopol seminars each year, but didn't actually have a chance to meet him face to face before today. So. All
right, good.
Great.
Well, speaking of faces, I know we don't see your partner John Loder today, and I'm glad for that because I think he's getting a little bit of a well-deserved time away from the office, or at least the virtual office these days, since we're all still in our home lockdown mode. So in the few minutes we have left, I did want to just ask you a couple of quick questions. So we always like to check in on what the stock market's done since the previous week. From what I've seen, it's continued powering higher. I think the NASDAQ and the S&P, and correct me if I'm wrong, but I think up until today, there had been 10 straight up days in the markets. And I'll let you comment on that in just a second. But today we did see a down day. I'm curious if you think that shows any particular, has any particular significance. One, because the NASDAQ did sort of touch its previous high and then has corrected off of that, at least in today. But I believe today we saw some island reversals. And if that's true, if you could explain to folks what an island reversal is, that would be useful as well.
Yeah, I mean, boy, this market has been just tearing higher. I think you might have mentioned earlier, it's had the best, what does it have? The best 50 days, I think, in history. And it's basically had a 40% bounce off the low as measured as the S&P. And of course, the NASDAQ hit a new high today. NASDAQ itself had a bearish engulfing day. That means it hit a new high above yesterday's day and then traded below yesterday's low. I don't really read much of anything into the short term anymore. As Wolf said, the Fed is pouring money into this market, so anything can happen in the short term. This is a really fragile, very contrived market, just powered higher by by speculation. Essentially two things: fear of missing out, or FOMO, and TINA. There is no alternative. Many conversations we're having with people, and we're having lots of new conversations, so we're very grateful about meeting some very good people. They're all saying the same thing. Well, geez, maybe some of them say they got out in March and they're feeling really bad. They're feeling terrible about getting out. Our message to them is don't feel terrible about that. Even though we've had a very sharp bounce, we still think this is a rally that will ultimately roll over. And others that have been in the whole thing the whole time are saying, well, gee, I don't think I want to get out because I won't know when to get back in. Everyone's afraid of the same thing. Well, geez, can't the Fed keep doing this forever? It was wonderful to hear somebody else answer that question, because at New Harbor, we're answering that all the time. And Wolf had a really good answer. No, they can't keep doing it forever. It just doesn't make common sense. But nobody knows when the public and when the markets will essentially figure out that they're out of ammo, that they can't do anymore, whether it's actually mathematically that they're out of ammo or politically they're under too much pressure. And it seems like politically might be the pressure that could eventually stop them. But as far as island reversals go, essentially that's when a market trades higher and then the next day, trades lower, leaving a small bar, all by itself. I really haven't seen much of that yet. It's possible that we might see that if we gap down tomorrow. A couple weeks ago, we talked about a bearish engulfing week, and the market's up 10% from that time. Just goes to show you how tricky it is to time short term. We think that the market's never been more overvalued. We think the market will likely trade 50% below here at some point in the next few years. We don't know when. That's based on valuations and measures that are highly correlated to what we're actually trying to measure, and that's future returns of the S&P. So our message is still the same. Be really cautious. You know, we talked about the hazards of shorting. We're not outright short for clients. We're simply waiting for a better time, and that's maddening to do. It's hard for investors, it's hard for money managers, but that's our discipline.
All right. Well, you know, one of the ways in which you can sort of trade or plan or invest with the expectation that the central banks are going to continue to print money is to purchase things that, you know, like commodities and specifically the precious metals, which in many ways are supposed to be an inflation hedge, right? And the technical definition of inflation is it's a monetary event where the money supply is increasing, right? And so that's what the Fed and the other central banks are doing on steroids right now. If you've read Prosper, if you've read Peak Prosperity's articles for any length of time, you know that Chris and I have been big advocates for people owning precious metals, at least having a core position in your portfolio as sort of a crisis insurance. And we've talked in past video updates here, Mike, about you know, the wisdom of doing so, how much to consider putting in your portfolio, all that type of stuff. But I know that still remains one of the most common questions that you and John get at New Harbor, which is either I don't own many precious metals, where do I get started? Or, all right, I've got some precious metals and I've got enough that I feel comfortable about controlling myself, maybe having it home somewhere or having, you know, somewhere close to me. And I don't want to have any more actual physical metal with me because it becomes either a loss or a theft risk at some point in time. And so they're looking for additional ways to hold more of their portfolio in gold and silver, but they don't want to necessarily hold it on their person. What advice do you give to people who come to you with that question, and do you get that question often?
We talk about precious metals all the time. The reason we talk about them all the time is because they're tangible assets. In the broader sense, we're big fans of tangible assets because they're somewhat outside the central banking control sphere. Not completely outside of their control, but somewhat. And in this crazy world of central bank money printing and hyper overvaluation that's the result of that, we like tangible assets. So we're always talking to clients and prospects about a few different things. First of all, reducing stock market exposure. That's usually the first thing we talk about. But very soon thereafter, we get an inventory of their physical asset exposure. Most people own a house. Most people, not all, most people own a house with or without a mortgage. And then in addition to that, some people own investment real estate, business interests, farmland, gold and silver. I would say the most important, the most common thing we talk about is gold and silver because it's so easy to buy, so easy to manage. There's no carrying costs for the most part, except some minor storage costs. So it's definitely going to come up in one of the first conversations with somebody new about whether they own gold and silver. If they don't own it, we're going to suggest they do own it. We suggest anywhere from 5 to 20% of your overall asset picture. And really, I've got to say that almost no matter what your net worth is, it's nice to have something meaningful, maybe $50,000 or so if you can afford it. Not everyone can, but if you can get there, it's kind of nice. In our view, it's a good hedge against a runaway inflation or a currency collapse at that level. If gold and silver goes up many times over, and silver could go up 10 times over, then all of a sudden you're talking about a real meaningful number in purchasing power. And many people could even deliver those metals against a mortgage and retire a mortgage in that case. But we would suggest for people to have gold and silver, particularly silver here in this case, with the ratio of silver to gold still around 100 to 1, historically undervalued relative to gold. And if you can take possession of it and have it nearby, that's great. Now, finally getting to your question, I think, what about if you're not comfortable doing that? I think the second best option is a good, trustworthy depository solution. And we often recommend Hard Asset Alliance. They are a very good option to buy gold and silver. You can store the gold and silver there, and it's allocated in your own name or segregated in your own name. So you know it's there, safe in a depository. You can take delivery of it either immediately or eventually. So how it would look is you send money to Hard Asset Alliance. You buy the gold and silver. If you want immediate delivery, that's available. If you don't want immediate delivery, it's held in a vault in the client's name, and they can take delivery of that whenever they want. However they get the exposure to precious metals, we think it's important to think about.
All right. Well, thanks, Mike. Couple of things. One, I will put a link up here on the screen. We have a primer or guide for how to buy gold and silver. And it builds on what Mike was talking about here. And a few things you said, Mike, I just want to mention as we wrap things up here. I think I heard you say that, it's always best to start with some physical bullion that you have in your own hands and have in your own control. I completely want to reinforce that. And that again, folks, is just for sort of crisis emergency preparation, right? If there's, highly unlikely, but if there's a currency collapse that happens in an extremely short period of time, as has happened in certain places throughout history, you want to have, something that you can get your hands on that is going to get your family food to a safer place across a border, whatever. And again, we're talking low probability here, but would it happen if you had some precious metals on hand? You're going to have a lot more options than most other people. And for that, there's lots of places you can go online and buy them. Online dealers like goldsilver.com or AppMex or whatnot. I'm a big fan of finding a local coin dealer in your own local area and forming a relationship with them. For a couple of reasons. One being you probably be paying about the same. If you become somebody's sort of trusted client, oftentimes they have a little bit of wiggle room on their prices. And if you've ever bought bullion, you know that the price you're paying is a combination of two things. It's the spot price of the metal and what it's trading at in the open market, but then the actual premium you're paying to get a physical manifestation of that in your hand. And to give you a good example of kind of the relative values, right now, a gold coin, if you were to buy a sovereign gold coin like an American Eagle, you're probably paying, spot price for that is about $1,700 right now. But you're probably going to pay close to $100 in premium on top of that. Right. So you become a dealer's trusted client. They've got some wiggle room on that premium they charge you. But what's also, I think, really useful to having a local source like that is when they give you, those folks really have their pulse on what's happening in the precious metals community. And so you get some interesting intelligence that way. But if you ever get to a point where we're in a true crisis, inventory is going to become very scarce. And so you're going to want to have somebody who knows you, and if he's got limited inventory, wants to sell it to you versus somebody else. And what a lot of people don't think about sometimes in a crisis is if it becomes a really big crisis, how are you going to sell it? Especially if we're in a world where things are locked down, not necessarily like a pandemic, but if there's martial law or, again, we're talking about low probability things here, but if you don't have the ability to sell to an online provider because either the internet is compromised or those companies are on some moratorium or whatever, you want to have some connections locally for people that can help you transact. So anyways, all the reasons why you want to develop a relationship with a local person, or at least good reasons to develop a relationship with a local person. But beyond that, as we said, you don't want to be, Mike threw out a pretty high number there of $50,000. I think most people, if you can afford that, and again, I think this is worth doing it, even if you only have a couple $100 to invest in, some silver rounds. But if you get above a certain amount, I think most people, it's not wise to keep that at home. Again, because it invites theft. You get a burglar comes in and finds it, it's gone. It's hard to insure. It could be lost in a whole variety of reasons, fire, flood, whatever. So finding alternatives to be able to store it remotely is important once you get above a certain threshold. And I think Mike did a really good job of at least one of the firms that you guys refer out to. And I know, Mike, you guys at New Harbor Financial, one of the many reasons why we really like you guys is that's one of the foundational things that you basically recommend people do really even before they open an account with you guys. I know you counsel people to pay down debt and get their debts under control, and then to get some exposure to the precious metals if they haven't already. And neither one of those things do you make any money off of. Those are things that they're doing with their capital before they even consider moving their capital potentially to New Harbor to have you guys manage the rest, in the markets. So again, I just think it really speaks to how like-minded you guys are with the peak prosperity mindset, but also how you guys are really oriented around, what's best for your customers. You want them to get on a good financial footing before they're even considering moving the rest of their capital to another provider. And I'll close as I normally do. We do these weekly updates because we want to make sure that you, the viewer, are as informed as possible in terms of what's going on in the markets so that you can make informed, intelligent decisions about your money. So with that, Mike, thanks so much again for another great week. I know summer's beginning to arrive there in New England. Looks like you guys are having better weather. I know John is off on a nice New England island for the next couple of days. I hope he's getting a chance to enjoy himself there. And I look forward to talking to you next week. And hopefully, as we said last week, hopefully the markets give us some more interesting action to comment about than just simply grinding higher week after week after week. I'm not sure if Wolf gave me confidence that we're going to break from that anytime soon with the Fed's $65 billion coming in every month. But I do think, to your point, the Fed is getting more and more blowback. And for a whole variety of reasons, I don't think they're going to be able to continue to pump out as much as they've been able to, or may decide that they just need some pause in the program to take some air out of the system. And so I'm continually looking at the tape because I do think that there will be a reversal day here pretty soon. Well, will it be the big one that turns, the bear market rally into the 80% correction that tends to follow in big market corrections like the dot-com bust or the Great Depression? Who knows at this point? But I do think that we have had such a dearth of down days over the past month that I think reversion to the mean, at least at some point, is going to have to interject here. But any parting thoughts on that before we hang up here for the week?
Well, the action right now is feeling and looking a lot like it did in prior short-term tops. January 2018, we just kind of ran for weeks and weeks and weeks, and then we broke. And of course, that came back and went to new highs a few months later. But most recently with the blow-off top that started, in my opinion, on September 17th, I think it was, in 2019, when the Federal Reserve started their not QE, essentially they re-engaged in quantitative easing. That was a multi-month blow-off top. And once we turned the calendar to January 1st of this year, it was literally every day, every week, just straight up 45 degrees like a ruler. And this feels a lot like that. You can almost feel it. It just feels dangerous. It seems like it's almost too good to be true. And that's how it's feeling again. Nobody knows if it's tomorrow or next week that things turn. We too hope that there's more interesting things happening in the market to give people opportunity, to buy at better prices and to give us more interesting things to talk about. If I had to guess, I'd say it's close. Certainly feels that way. We'll see.
All right. Well, hey, thanks so much, Mike. Have a great weekend and look forward to picking up in a week on this with you.
You too, Adam. Thanks for having us back. We appreciate it.
Take care, Mike.
See you. Bye.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because peak prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.